again for joining us. So, my name is Justine Kogel. I am a program officer at a Keepton. For those of you who aren't as familiar with the Keepton, just a little bit about us. We are a Native Community Development Financial Institute. And we were founded back in 2019. And so we've been working at this for a little while now and have been experiencing some great growth and opportunities. And so you're going to learn a little bit about what we are and what we do. Today, you guys are on the 2026 Cattle Market Outlook. We have the Griffith Endowed Professor and SDSU Extension Risk and Business Management Specialist, Matthew Diersen, here with us today. So thank you for joining us. As we go through the day here, I'm going to give just kind of a brief overview of the Keepton, and then we're going to kick it over to Matt, and he's going to go through what our cattle market outlook is. So here at a Keepton, our mission is to transform native agriculture and food economies by delivering creative capital, leading paradigm changes, and enhancing producer prosperity across Indian country. We take this to heart. This is what we've built our entire organization on, and every staff member that is outward facing, so our loan officers, program officers, we are all involved in agriculture as well. So we really do believe in our mission. Our vision is a Keepton envisions a future where Native producers across Indian country have unrestricted, equitable access to capital, tools, and knowledge that supports their growth and prosperity. Our systems reflect traditional values, responsiveness to needs, and drive innovation in food and agriculture, filling the financial gaps and restoring Native stewardship with the land, food, and economies. So for those that are unfamiliar with a Keepton, the word a Keepton is the Lakota word for working together in a cooperative effort. And that is our entire philosophy. CDFIs are like banks in the sense that we provide loans, but we are not a depository. So we can't actually take deposits from folks. We are also different than banks because we get to do something called technical assistance along with any of our lending capabilities. So we really get to sit down with producers and assist with business and goal planning, succession planning. We do a bunch of financial literacy stuff, and we get to do webinars like this to help bring the markets right to you. And while there are laws that we do follow, we are relatively unregulated, which allows us to really have that flexible lending capacity. So since starting in 2019, we've reached 37 tribal nations, and we've committed over $44 million in lending capital. We're a team of 16, so we consider that a huge win in just a very few short years. We have 613 loans, and that number goes up by the day because our loan team is incredibly amazing and working very diligently. Right now, we are offering a youth loan, a general loan, operating loan, and a line of credit, land mortgage, and down payment. And so basically, the eligibility that you need to have is you have to be involved in the native agriculture field, and it's anything on the food chain from initial production to retail. And so thinking of farming, ranching, fishing, timber, retail, value added, these type of things are all things that we look at for our lending opportunities. Right now, our interest-only option, which we're going to talk about in just a minute, we do have an interest-only option. The interest rate is 6.1%. And our blended, which is our more traditional style repayment, which is the principal and interest, is at 3.6%. And so we do our best to keep our capital at a low cost to all the producers. So again, like I mentioned, a Keepton has a couple different repayment styles. We have your traditional, which is where you're going to amortize out over a number of years. You're going to pay principal and interest on every payment. And then we have our interest-only payment, which is really great for those who are working on growing their operation. I look at it kind of like that heifer retention. If we do an interest-only option, you're going to pay literally the interest only for 5 years. And then the entire principle behind it is to reinvest that principal amount in keeping back your cattle, improving infrastructure, improving efficiency. If you need to purchase a different piece of equipment for your crop, it's giving you the ability to do that without taking on more debt. And so we offer that. It is an amazing opportunity for those that are growing. And so we just always want to make sure everybody on our webinars has a little bit of background. With that being said, I'm going to go ahead and introduce our special guest today. Matt Diersen earned a BA degree in economics, City of Minnesota Morris. Whoop whoop, go. I've got a niece over at Morris right now, so very excited about that, Matt. And an MS degree in agriculture economics at North Dakota State University. He also holds a PhD in ag economics from the University of Illinois. Matt teaches courses on commodity training and agriculture finance. His scholarly work is focused on pricing mechanisms and financial risks across extreme time spans. His SDSU extension programming focuses on interaction of commodity marketing and insurance tools and changes in the ag economy. He enjoys applying portfolio theory and economic principles to everyday life. Matt is originally from Minnesota, but lives in Brookings. And I will tell you all, like I was visiting with Matt earlier. He actually was a teacher back in the day when I was in school at SDSU. So I've known of Matt for a long time, and we really are just honored to have you here with us today. So thank you, Matt, and I'll kick it over to you.
All right, thank you for that nice introduction. I'm going to get started then. I've got some just comments, observations, and some thoughts about the cattle market for this coming, well, really for the next few years, for cow-calf producers in particular. They tend to think in terms of a few years out. So make some comments and observations, and if you have questions, really at any time, feel free to jump in and ask me those questions. So here goes. A few non-cattle prices, but just for perspective. Much of my information comes from the Livestock Market Information Center. That's a collaborative outfit of land-grant universities that support the LMIC. They're located in just outside of Denver, Colorado, but we support them with our tax dollars, and they in turn provide some information to us. So these are some price projections from them, and you'll see some maps and charts from them as well. But for 26, 27, they see much lower corn prices than last year, much lower soybean prices than last year. And perhaps most important for the cattle sector, a lower hay price. So hay has been really a limiting factor for several years, especially for cow-calf operations. Western half of the United States had production problems, but they see the price level coming down, and lower corn and lower hay prices generally means better or higher calf prices. So those prices, when they've come down from even higher levels over the last few years, have been partly responsible for increasing or pushing up the value or the price of calves and feeder cattle across the country. So locally, how would you use that information? You could say you could have some downward pressure on your corn and soybean and hay prices. And of course, with hay, very local markets. So if your local situation is extremely short of feed or for some reason, then you could see prices deviate from that quite a bit. The other thing with the hay and forage, again, as it relates to cattle, there was a slight increase in hay stocks as of December 1. So this is from the January crop production report, but just to show visually that, the hay stocks, hay is available across especially across the central United States. Montana, North Dakota, Minnesota had relatively good hay stocks. My way to measure this anecdotally is when I end up on I-29, the interstate across the eastern edge of the Dakotas, do I see hay trucks, and what direction are they moving? How heavy are they and such? And there hasn't been a lot of hay trucks moving the last few years, but the The last 6 months, I've seen loads of hay coming from the north, headed south. So that tells me that there's a supply out there relative to say normal or what's been the case the last few years. Now, it's not a huge increase in stocks, but it's moving in a direction that would be favorable to potential expansion of cow herds. The other thing with hay, is it with cattle prices the way they are, is that really going to lead to producers doing widespread expansion of the cow herd? I don't think so. If we look at this is strictly alfalfa new seeded acres, but if there was really a demand on the part of cow-calf producers being willing and able to greatly expand the cow herd, that's going to take some forage built up or stockpiled in general. And this is a map showing the change in alfalfa mix acres for new seedings last year. So last year, they didn't plant extra alfalfa anywhere. In fact, alfalfa acres, in terms of new seeded acres, actually went down across most of the upper Midwest and across to the Pacific Northwest. So again, I don't see any indication of greatly expanding hay supplies, which would facilitate expanding cow herds. So just another indication on the feed side of things. Grazing fees, these were released. So these are fresh numbers. These were in the January agricultural prices report done by NASS. So you can see for North Dakota, South Dakota, Montana, for example, Wyoming, you've got about $1 per AUM increase compared to last year at this time. So grazing fees have gone up slightly. I've been trying to look at and seeing if grazing fees, how they would play out in terms of a cost of gain or a cost to run yearlings in a year like this, because you'd have a handful of producers that have been looking to expand, and they're talking about other producers being less enthusiastic about expanding the cow herd. So you might have some increased desire to run cattle on grass as yearlings and such, and continue to kind of crunch those numbers. But it is something that might help drive, or it's a factor I see as being something that hasn't gone up at the same level that cattle prices have gone up. So it's kept in check a little bit. And part of that would be like in South Dakota, for example, cattle profitability is high, but you've also got a decrease. We have a decrease in beef cow numbers. So the demand for grazing units is actually gone down a little bit because of that. So another factor. Then a couple things specific to when I go to the store and I try to buy some beef, either steak or hamburger or something, a little bit of sticker shock. Well, a lot of sticker shock. And I think this is a limiting factor. So beef prices have got a little bit high from a consumer standpoint, and that puts a cap or a limit on just how much higher cattle prices could go. So if your final product, beef, has become more expensive, what's the consumer going to do? One of the things they could do is look for alternatives. I actually reached out to our extension nutritionist and I said, is there anything I could buy as a consumer that would substitute for beef in a diet? And she threw out things like peanut butter and eggs. So peanut prices are very low down in the southeast part of the United States. Grab some egg prices here, much lower than they were, say, a year ago at this time. So the consumer is realizing this too, and it just means that you've got some headwinds in terms of having any further or greatly increased beef prices. That's gonna be a limiting factor there. Got some other charts that show this as well. So here's just the retail price comparison. So all types of beef that you'd buy at the retail level, so at a grocery store. You can see that late in 2025, that price for beef got above $9 a pound, compared to pork being closer to $5 a pound and poultry down there at about $2.50 a pound. So beef's the only one that's gone up dramatically or continues to go up compared to those other meats. So you're really pushing the consumer or making it difficult for the consumer to continue to purchase the same quantity of that product unless their incomes are going up. And I don't think that's the case when you look across a broad cross section of the US consumer at this time. So very much a limiting factor. So feed is lower, but retail is high, and that could limit fed cattle prices. Here's some prices for South Dakota um, for perspective or for comparison. So throughout 2025, prices in general for calves, feeder weights, fed weights, and cull cows tended to move higher, putting in some very high levels in October. Still a little bit of seasonality in all of these prices, even at these high levels. Um, and the cull cow price, for example, just for perspective, I'm going to grab a note on this. For several years, that had been running about, maybe I don't have my note on this. Yeah, I'm going to do it without the notes. The price for cull cows had been running like something like 65-70% of the price of steers, and that had backed off a little bit here during 2025. So I mean, you've got a few different dynamics going on. And the other thing, just in general on these prices, it really wasn't until 2025 that the price of calves, that stocker price there, that's cash price, 500 to 600 pound steer sold at a South Dakota sale barn. That price really didn't get above the previous cattle cycle expansion peaks in 2014-15 until 2025 on a real or inflation adjusted basis. So, um, so why haven't we seen cattle producers expand before now? Well, in terms of real dollars or real return for generating more calves, the returns weren't there until this last year. And this picture is a little hard to digest. This is June live cattle futures from the last 10 years overlaid on top of one another. So it's always looking at a June expiration futures contract year over year over year. So a couple things. Last year is that green-ish line going across there that finished at $225 a hundredweight. So that was last year's June live cattle futures throughout the previous 12 months. The light blue bold line up here on the top of the screen, that's this year's June live cattle futures contract price on the board. So as of today, so we'd read that in the middle of the picture there in the upper or very top of the picture up there. June cattle been trading for about a year. And as of now, mid-February, they're at the highest price level they've ever been at this time of year if you were to try to lock in a price for live cattle, so finished weight cattle on the futures market. So from the future side, you've never had an ability to price cattle for June like you have right now. So that's good news for the rest of the cattle market as well. But just for perspective, so you've got high prices on the fed cattle side of things carrying over to the other types of cattle as well. Live cattle basis for perspective, basis cash price minus futures. Last year, 2025, South Dakota. So this would be out of Worthing, South Dakota. It's a deliverable location for live cattle futures. Track the cash price there, take the cash price minus the nearby futures price. So if you're hedging fat cattle, it gives you a basis level to use throughout 25, except for the month of December. Basis was above its prior 5-year average. Not by a lot, but This is good news as well. So if you had hedged July cattle, you'd have been surprised by a positive higher basis level. It would have worked out well for you. You'd have been disappointed in December, expecting about a break even with the futures price and that actual cash price and reflected in the basis. It would have been quite a shock, or perhaps not a huge shock, but would have been disappointing to see a wider basis. What do you do moving forward on fed cattle in particular? I like to maintain or use a 5-year average basis. So I would continue to do that for 2026. And I've got an article about that coming out probably tomorrow on the Extension SD State EDU webpage. So look for that on the fed cattle if you're interested or have finished cattle. A couple other things with fed cattle. Um, yeah, weights have gotten heavier. So here's a snapshot right at the end of 2025 or beginning of 26, just showing the full calendar year impact of cattle dressed weights. So all classes of cattle, steers, heifers, cows, bulls, all averaged together here, but just to show that dramatic increase in slaughter weights from 24 to 25, and then especially compared to that prior 5-year average. So weights got bigger, but throughout the time weights got bigger, it's not enough to offset the absolute smaller number of cattle being slaughtered. So production has continued to kind of contract, giving us higher prices. So there's a limit to how heavy weights can get in a short run because packing plants and such can only handle. There's a limit to how big of a carcass that they can physically handle in the plants. Cattle on feed situations. So there are fewer cattle on feed now than a year ago at this time, and also compared to the 5-year average. That's predominantly because of fewer feeder cattle from Mexico. I'll show a chart of that, but just so you're aware, there are fewer cattle on feed at this time. A couple other things from placements. There are fewer cattle at light weights being placed. Talking to a couple of cattle feeders about this, it's like, yeah, we really don't want to have lighter cattle in the pens because that's a longer time period where we're exposed to the risks. We prefer to buy heavier calves or heavier feeders and have them on feed for less time. So some of that's coming in or being reflected in aggregate as well. At the same time, because there's fewer cattle around, fewer cattle for replacement or to have as placements in feedlot, especially in the southern United States and the feedlots in the south. Number of cattle on feed more than 120 days is running much higher than a year ago and the 5-year average. So weights are heavy, cattle are being placed, trying to buy heavier, but being held longer and fed longer to produce as many pounds as they can per animal being fed. That generally is depressing on or downward pressure on prices as a result. What was looking like really good news, and now it's like, so it's kind of adjusted back. The percent or the share of heifers on feed. So feedlots are made up of predominantly steers, but also some heifers. A heifer mix would typically be about 38%. When that heifer mix gets high, like it had been from 2020 through 2025, a high heifer mix means that a lot of potential replacement heifers are instead in the feedlot being fed to turn into steaks and hamburgers and other beef. When you have a cattle cycle expansion, like happened on the left-hand side of this chart, or 2015, that area there, the heifer mix got to be really, 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 really low. So when the heifer mix is only 30%, all the heifers that could be going into feedlots are being held back by cow-calf operations, developed as replacements, and eventually expand the cattle herds. So at the last 3 quarters would be this dip shown here. And let's see, do I have a laser of some kind or something? Try this. So this area right here, Justine, can you, okay, no, she's nodding, she's seeing that. So um, that time period there was just oh, you know, starting to get, oh, hey, maybe we're starting to see the beginning of the indication of possible expansion. And now then the party's kind of over. So this very latest quarter, so as of January 1, that heifer mix had ticked back up just a little bit. So that also says, hey, we're not going to quite be able to expand yet. We're going to take those heifers, move them to the feedlot, and produce more beef out of them rather than produce another calf a year from now. So depending on your perspective, that's it's just an observation if that's good news or bad news. A perspective. Mentioned Mexico, so depending on where you are in the country, you may hear more or less about the New World screwworm and its possible um, animal health implications. It continues to be a problem really throughout Mexico. So the border remains closed. So the United States won't be importing usually feeder weight, relatively lightweight feeder cattle from Mexico, predominantly into southern U.S. feedlots. So think Texas and New Mexico, oftentimes. So this is a weekly chart. So in a given week, it wouldn't be uncommon to have 20, 30,000 head or about 100,000 head per month coming in from Mexico. Hasn't been any for about 6, 7 months. And the cumulative effect of that, so if you kind of have the math kind of overlay itself for a while, so 100,000 fewer head per month, but at some point they roll off. They are coming in and going into a feedlot. So you have about 300,000, 400,000 head impact. So those cattle aren't there. So two reasons that's important. It accounts for that gap or the space. Why do we have fewer cattle on feed now than we did a year ago? Because we haven't had any imports from Mexico for 6 months or 9 months. And there are times when there wouldn't be cattle from Mexico, but this is all because of the border being closed and the screwworm concerns and considerations. Now, if something were to happen in the short run where that would be alleviated, there would be a backlog of cattle that could be brought from Mexico into the United States. So the retail level, I see pressure that will keep live cattle from moving higher. At any point, if the border can be reopened and allow feeder cattle from Mexico to come into the United States, that would have an overnight or immediate impact on the price level for fed cattle to a certain extent, but especially on feeder cattle and calves, you'd have huge downward shift on the value of those, on value of domestic animals at that point. So I would count that as a big or major predominant risk that could happen anytime in the next year, which is really hard to plan for. But if you're going to be marketing calves, you're going to have one time to do that next year, this year here in 26. Be concerned about the border reopening and the price taking a substantial hit if and when that happens. Couple of maps. So here's the all cattle inventory. So where you see a darker state, they just have more cattle. This is all classes of cattle. So South Dakota, 3.55 million head there. That's up just ever so slightly from a year ago. Texas, of course, huge cow-calf state, huge dairy state. So that's reflecting a lot of things. California is very large predominantly because of dairy cows out in that state. So no huge inventory adjustment for any state in the last couple of years that really stood out to me. Just slight adjustments, and for the most part. But there's a picture of where the cattle are. Here's specifically beef cows that have calved. So you can see Texas stands out again with 4 million head of beef cows. So, more beef cows in Texas than in all of Montana, Idaho, and Wyoming combined, for example. So now at the same time, Montana stands out as a huge cow-calf state. South Dakota, Nebraska, huge cow-calf states. Missouri, huge cow-calf state. And to some extent, don't forget Florida is a cow-calf state as well. So just for perspective. Most of the other categories in terms of breakdown were pretty steady. Got a couple of charts showing it differently here. So here's heifers held as beef cow replacements on January 1. That number is, around 4.6 million heifers held back as beef cow replacements, up ever so slightly from a year ago. So not quite an expansion level number. So if you're really expanding the beef cow herd, you're looking at the last time big expansion numbers were happening, and you had the 2016-17 area there with about 6.3 million head. So having 4.6 million head is not expansionary in terms of big numbers, but it's a move in the direction of, hey, we could add some cows and add calf crop here in the future. So for what it is. There has been a handful of replacement heifers priced at very high prices. So just a slide and spread snapshot from November of 25, but late October, early November, fair amount. So normally you'd see for a 5 to 6 weight animal, say around a $50 to $60 100 weight spread between steers and heifers. Heifers getting a discount because they finish lighter and gain a little bit slower than steers in a feedlot. Now at the same time, last year, I just throw this out there because last year during the fall, you were having replacement heifers priced at about the same level as steer calves. So that meant that there was some producers willing and able to pay very, very high prices for heifers to be used as replacements. And the last time I remember something like that happening, showing my age, was the last cattle cycle expansion of 14-15 in that area. So doesn't happen often. So I thought, well, that's kind of interesting. And so there you go. Cattle inventory where it is and where it's headed. So this would be a projection of the cattle cycle from the LMIC, and that their optimistic and pessimistic range is there on the right hand side. So if we start from today, the cattle cycle could continue for several years. And at the same time, in the best case scenario, maybe this fall, a slight increase in expansion or a slight increase in replacement heifers, leading to a little bit of an inventory expansion starting already in 27, or a year from now. But that's kind of the range of what their projections would say would be ways for this to play out from a pessimistic and optimistic range. Regardless, it's not going to do tons to move the price of calves, for example, in the short run based on inventory changes alone. Cattle on feed across the number of cow-calf or number of states with reporting cattle on feed levels. So this is large feedlot cattle on feed numbers. So it's not all feedlots, but in terms of where cattle are fed predominantly, again, Texas leads the way, but you got close second would be Kansas and Nebraska. And then Iowa, for example, and then a certain amount of feeding in Minnesota and South Dakota. There'd be a handful of feedlots in those other states, but just big picture, that's where the cattle on feed are right now. Feeder cattle supplies outside of feedlots. This is a residual calculation, kind of hard to get your head around it once in a while, but it's heifers that aren't replacement heifers. So other heifers in a cattle inventory plus steers weighing more than 500 pounds plus calves. And then, so that gives you a supply of what could be drawn into a feedlot, but then they subtract off how many are in a feedlot already. So that leaves this residual feeder cattle supply outside of feedlots. up and down the middle of the United States. Looks a lot like the beef cow map looked. And it's also somewhat similar to the cattle on feed map. So it just kind of shows that, hey, here in the central part of the United States is where the calves are, it's where the feedlots are, it's where the cow calf and the numbers of cattle outside of feedlots are all present. What does that look like in terms of, the trend over time? Slight increase this year compared to last year. A couple things might be explaining this because of the feedlots doing what they're doing, trying to just buy heavier stuff, not keep it as long. Other parts of the cattle supply chain, um, cow calf operator, if you've got feed, you might hang on to that calf a little bit longer. If I'm backgrounding, adding some weight to the cattle, I'm trying to use any feed I've got there too to put a couple more pounds on before I send it to market. So you're kind of slowing things down a little bit and adding more pounds everywhere that you can. And that could be part of what's explaining that slight uptick there in terms of why is there a slight increase in feeder cattle supplies outside of feedlots. So, and then the absolute number of big drop in cattle on feed. So this isn't a price, or this isn't an inventory level to wreck prices or anything like that. You can see remains very tight relative to where it's been throughout the last or this most recent cattle cycle. Feeder cattle futures. So this is a very specific feeder cattle price off the board. So this is all the last 10 November feeder cattle prices or November feeder cattle futures prices from when they start a year until for the full year before the contract expires the Thursday before Thanksgiving during the month of November. How's that? So it's also the futures contract I look at most often just to get a feel for, hey, what are feeders doing? Because that's going to tell me what calves are probably going to do. So a couple lines going across there. Again, there's that greenish line across the top. That's last November. That's the November 25 contract that went off the board right before Thanksgiving a year ago. And then you've got that, so late October, super high, record high price levels at that time. But here in 2026, the November contract, since that last one went off the board, so it's trading at around 350 right now. This was as of yesterday after the market closed. So never before have you been able to use the futures price and lock in this high of a price level for November feeder cattle than you are able to do right now. So we blew through the 2014, 15 prices a couple of years ago. Sometimes it's fun to show those as well. 2014, 15 would have been the last high price thing, but much higher than that right now. So that gives you plenty of reason to be optimistic for calf prices this fall. So 350, haven't been able to price like this. That would be about $100 a hundredweight better than last year at this time. So that explains why calves in the sale barn are pretty high price right now too. Feeder cattle basis, this is South Dakota. So the cash price here is cash price for 7 to 9 weight feeders, steers only, just for the pricing and relative to the nearby futures price. So the basis during 25 was much higher than the prior 5-year average. And then in November and December, it got ridiculously high. So very, very, very high. How many berries can you have? Very high prices. And yeah, for no quantifiable reason whatsoever, other than perhaps the relatively limited supply of cattle in the northern plains or in the United States favoring cattle from the northern plains. So the entire U.S. feedlot situation was we don't have any feeder cattle, or there's only so many feeder cattle to draw from. The only place they're available is up north. Let's go up north and pay for feeders. And an increasing price level throughout the year was also a driving factor behind that. What do you do going forward? If you are looking to hedge, um, market feeder weights, 7 to 9 weights, um, still would be, I would tend to use a 5 year average. Um, so I'd take the last 5 years and use that for planning purposes, or you could kind of split the difference between what you see in this chart between the orange bars there. So I'd split the difference and I'd go say maybe between $5 and $10, and I'd use something, $10 would be reasonable or something. And this varies substantially when you go the further west you go from South Dakota, or further north and west. You're not going to have that strong of a basis. Um, uh, the further from South Dakota you go. So that's there. And feeder cattle contracts. A couple things to highlight there too. These are traded in the Chicago Mercantile Exchange, but they're cash settled, which is really nice. Futures and options both expire the last day. 7 to 9 weights is what you're looking at. So when I see a futures contract that's reflecting 60 head of feeder weights or 100 head of calves, really is what that's reflecting. I mentioned the months, so let me back up a second. Normally you've got Jan, March, April, and then November. So the weird break is no June or July. About 9 months ago, the CME announced a change, and they were adding a futures contract month to be listed at the back end of things. So what does that mean? A year ago, so if you look on the extreme right-hand side of this chart, a year ago, the farthest out you could have gone out and looked at a futures contract trading would have been January of 27, or this year's January futures price. And a year ago at this time, 29 of those contracts had traded and were open interest. So they're a buyer and seller, and there was an open position. So think of 30 contracts being sold and sitting open. This year, or this last year here now, they announced adding another month to the back end. Well, adding another contract month gives you 2 additional months of futures time. So as of today, you can trade or you could hedge out to March of 2027 from today. So that's kind of neat. Lets you get further out with your risk management. And since you can go all the way out to March of 27, you're able to match for the feeders. You can match, or in some cases, even exceed the duration you'd get if you were trying to use livestock risk protection, which only goes out to 52 weeks or 1 year. The other thing with forward, it relates to forward contracting. A lot of cattle in the Northern Plains, South Dakota, North Dakota, Montana, Wyoming, Idaho, a lot use video auctions. And this is a cross-sectional snapshot of the video auctions that happened last July. So last July, about 750,000 head were run through video auctions. About half of those came from Northern Plains states. So with the ones I mentioned, and at the same time, an observation we had was a whole lot of those cattle aren't for delivery today. So you observe a transaction in July, but delivery could be August, September, October, all the way through April of 2026. So last July, cattle were being traded, weren't really going to move locations until as late as April of this year. So we're using that information to improve our ability to forecast, or our process we use to forecast cattle on feed placements. And we're finding some different information with that. Just wanted you all to be aware of that. And it is something that, hey, there's forward contracting with feeder cattle, and it's a big deal. It's a big number of head. So, you got 750,000 head transacted last July, and 700,000 of those were for forward contract delivery. It also means you're taking on some relationship risk. You have to have you need a competent buyer on the other side. So that's risks for all the parties involved, including the lenders. lenders. They should take note of that. So there. Um, Calf prices. So this is 5-6 weight steer price, South Dakota sale barn. Um, yeah, this makes a lot of work for me. I have to keep adjusting that price chart on the left-hand side there. So this is dollars per hundredweight. Last October, it topped $500 a hundredweight. So 550. So uh, 3 grand or something for a calf. Maybe doing my math wrong, but lots of money. And that price has stayed fairly constant. Has not topped $500 here since the beginning of the year. It's gotten really close. So calf prices stay high. Basis, yeah. What do you do? Um, you could try to hedge these calves, a 5 weight against um, a 9 weight feeder cattle price. Yeah, don't use a 5-year average basis. Last year, 2025, you had prices for fats and feeders increasing throughout the year. You had a much lower corn and hay price kind of occurring or realizing those lower prices throughout the year. All of that meant extremely high basis levels compared to the 5-year average. So 1.5 times the already very high prior 5-year average. Don't use a 5-year average um, unless you're a buyer. So from a seller standpoint, yeah, you don't want to use that 5-year average. You could use last year's basis as a rough start. But I also take, yeah, I'll try my notes. I do the math kind of like this. I take a feeder weight and then I say, to get to a feeder weight, I'm going to need about 1.1 tons of hay and about 16 and a half bushels or 15 and a half, 16 bushels of corn to get there. So then I take the South Dakota price for those things and I shove them in there and I have to make some forecasting assumptions too. But if we use $4 corn and $100 a ton hay, my feeding cost is going to be about 170 to $175 a head. And that would give me an implied basis around $125 right now to get me from a calf to a feeder on the board. So 125 is not a ridiculous basis to talk about here in South Dakota um, for as long as those prices hold. So downward pressure on feeders would put downward pressure on the basis. And it's difficult or tricky with a calf basis, and I just wouldn't use a 5-year average. Last year's is a rough guide, but even last year, if you're going to use $80, you're going to be $70 a hundredweight short. 70 a hundredweight times 5, 7 times $350 a head. Whoopsie, that's a small mistake. USDA baseline. I This is a preliminary set of numbers, and there's something really messed up with the numbers they're throwing out. So I like their calf price level. I buy that $400 calf price. Next few years, 26, 27, 28, but I don't like this big spike in 27 inventory. I just, there's something not right with that yet, but this was a preliminary number, so take it with a grain of salt. That'll be revised here in the end of October, here in the end of February by the USDA. Some live cattle some price projections again from the LMIC. They see prices for 26 for live steers being up a little bit from a year ago level. So this is a full year. Feeder steers, they're seeing, you see 362 would be the midpoint of that, or $30 a hundredweight higher than throughout 25. So locally, you could adjust your feeder price by say $30. These are southern for the feeders and the calves. These are Southern Plains prices, so not really reflecting the level of prices. That's why I would take that price change and say, okay, I can expect $40 higher for a calf price here in 26 compared to 25. And that's based on fundamentals for the full year, not the price on any one day of the year. Price volatility. It's taken right from the CME. I can use other measures of implied volatility, but this is the recent volatility, predominantly of the nearby contracts. But um, for live cattle and feeder cattle, you can see that volatility got up into the mid 20s, so mid 20%, or when volatility is at 25%, livestock risk protection, put option coverage is going to be very expensive. The volatility falls when it's down around 10%. We're really happy. Volatility is cheap. Livestock risk protection, put option coverage, very affordable. It got really high at the end of 25, backed off right at the beginning of the year, and now it's moving up a little bit. I'd say it's a very normal level or a very average level at this time, but it's up a little bit from where it's been in recent weeks. LRP, how am I doing? Okay, time is okay. Um,
Yeah,
Real
we're
quick on
doing all
LRP.
right on time, Matt. But just to let
Okay,
everybody know, if we do go over a couple minutes, this is recorded. If you have to get back to your lunches, we understand. Go ahead, Matt.
okay. But with LRP, it's very common right now. It's only coverage from 13 to 52 weeks. So that 13 week is the constraining factor. So if you have cattle and have protection in place and prices move dramatically higher, and you're within 12 weeks of marketing, you might look at using put options or even futures prices, selling futures to lock in a better price, get a better floor price than you can get strictly using or compared to just using or limiting yourself to just LRP at this time. LRP works really well. It's good, but it has that limitation. It's heavily subsidized. I'll show a table of that subsidy too. That subsidy was very low. Predominantly, it was 13% for like forever. And then they got it a little bit higher, and then in like a span of a year and a half, it went from 13 to as high as 55%. So if you really wanted to get minimal amount of coverage, covering the break even on a cow calf operation, and you bought a way low absolute level of coverage, you're only going to pay 50 cents on the dollar. So if an out of the money put option on feeders to hedge your calves would cost a hundredweight, it's only going to be 50 cents when you get the equivalent through LRP. So LRP is a good deal. That subsidy is real, and producers have responded. So here's a time trend showing that prior to the subsidy, not a lot of head got covered, some in South Dakota. And then in 2025, about 6 million head were covered. So U.S. calf crop, about 30 million head. So one in every five calves was covered by LRP last year. Year to date, this is on a fiscal year. So we're only halfway through an LRP fiscal year. So that's why the 26 number looks so low compared to 25. It's just because we're only halfway through the year. So I expect that the number insured in 26 would exceed the 25 level. Um, Total calf crop, just to show you where LRP is or isn't getting purchased. Total calf crop. So this is dairy cows and beef, or dairy calves and beef calves, but concentrated in the Central Plains states, from South Dakota down to Texas. So put that image in your head for a second, and then I'll show you a map of where LRP has been purchased. Now, it's a slightly different map format, but you can also see that across the central part of the United States, again, fair number of cattle are covered with LRP throughout the Central Plains states. This is feeders of all types, and you can see it if you do the math and compare the number, for example, in South Dakota, about a little over a third, almost half the calves in South Dakota would be covered by LRP. Or if we compare that to Montana with 1.2 million for a calf crop, only 196,000 covered by LRP. So LRP is much more common in South Dakota than some of the neighboring states. So again, it's just an awareness thing. It works the same everywhere. It should work for cow calf operations. no matter where you're located. It does some little assumptions with basis and such, but it's about getting um, some coverage in place on calves when you've got a limit to how high fed cattle can go, when you've got feed that's reasonably priced at the moment, and when you have an external risk of a border with Mexico opening up, bringing feeder cattle in the United States, pushing down calf prices in particular, especially from all-time record high levels. Hey, that's it. If you want some more information, I've got a session with Beef HQ Live through SDSU Extension. I believe it's next week or the week after or something. So it's coming up. And we've also got our Ag Economic Dialogues webinar series. And both those are free and available to anybody that registers and wants to tune in. If you've got questions for me,
Haven't seen any drops. Matt,
no
you
questions.
were so very thorough. Um, that was an amazing presentation. I really, really want to thank you for being here. Um,
No problem.
we're gonna go ahead and I put the extension website right into the webinar chat so people
Okay.
had that because I think it's such a valuable tool. Even if you're not in South Dakota, folks, you can use SDSU extension. You can use your own state extension. Very great partnerships for our rural communities. I have just a couple things to go through, a little bit of housekeeping before we let you all go. So what we've got here, I just want to let you guys know we've got a bunch of youth initiatives coming up, and we're going to have a webinar just based on this. This is scholarships for kids who are wanting to go into something agriculture related. It could be something like what Matt does here with ag economics. It can be learning higher education about accounting, so you can step into the role of a financial advisor for farm and ranch, anything from that area. We also have a business plan contest, which is cash prizes coming up, and our summer youth internship. So those are all for high school age kids. So please get a hold of us for more information on that. It's all on our website as well. Um, Wanted to also let you guys know we've got the Youth Initiatives webinar coming up on February 24th. We also have a two-part workshop called Let's Get Growing. That's going to be super, super fun. It is all about agribusiness, taking a look at numbers, and really putting that pen to paper to make some of these business decisions now that we know the markets around cattle. So join us for that. Always remember that on our website, we have all of our past webinar recordings. If you guys want to go back through, Matt threw a ton of information at you and it was amazing. And I know I'm going to end up rewatching this and studying some of those slides. And so I really encourage you to do that. Make sure to go ahead and sign up for our newsletter. You can scan the QR code here. This makes sure that you have all the latest and greatest information of what we're doing and what's coming next. So keep up to date with us on that. And then also, we're hiring. So we are hiring right now for a communications officer who's going to be responsible for overseeing our communications efforts and putting our communication plan to work at a keep ton. So if that is something you're interested in, please let us know. We are available in here. And last but surely not least, we ask you guys to fill out this feedback survey. I'll drop it into the chat as well. And we ask you guys to do this for a number of reasons. Number one, it lets us know how we're doing, but it also has an opportunity for you guys to let us know what other types of webinars you would like to see. And this is where we initially got the information that, markets are a great thing to do. And so then we reach out to folks and we get that information brought back in. And so please, please take a few minutes to fill that out. Remember that we will be sending out a follow-up email to everybody here with the information. We'll also make sure that you guys are aware of the law or the registration links for Matt's upcoming webinars and things like that, because this is a very valuable option that we get to have. And we just really want to thank everybody today for being here. We want to thank Matt, especially for taking time out of your very busy schedule to work with us at a Keepton and work with the entire cattle markets for producers that are actually on the ground doing this. So thank you all so much, and I hope you guys have a great day.